My name's Toby Blyth. I'm one of the partners at Collin Biggers Paisley, and I work in the financial services group here. What we do, we have what we call a cradle to grave. It sounds awful, but we sort of starting businesses in financial services and regulatory through to running them, and privacy advice and regulatory advice and data breaches and regulator interaction down to regulator investigations and litigation and the winding up as well. So that's why we call it that cradle to grave.
Yep. All right. There's a lot of talk, or there has been a lot of talk recently about placing buy now, pay later schemes under credit regulation, similar to home loans. They have to do all the due diligence, do all the checks and balances. Could you see this happening in the near future?
I think there was a Senate inquiry, I think, remember?
Yeah, there was.
And there was what the Americans call a classic Baptist and bootlegger coalition, and the banks and the consumer advocates both wanted it regulated for different reasons. The consumer advocates, because they are concerned about whether or not it's in the best interests of consumers. One might question why the banks wanted it regulated, since I can understand it might be a competitor to the normal banks. So you had a very strange alliance of people from both ends of the spectrum trying to get buy now, pay later in the middle. Generally, weirdly, things have slowed down a bit in the regulatory sphere, I think, because the Royal Commission released a whole pile of new recommendations. There were Senate inquiries, there were lower house inquiries on certain things, on life insurance, buy now, pay later, all of these things. And they're all due to come in this year. For various reasons, regulators and the legislatures got sidetracked this year. So I'm not sure. The easy things are being brought in. I'm not sure this is an easy thing, because there's a lot of consumer benefit to buy now, pay later schemes. Putting aside some of the more egregious examples of payday lending and all that, which did get cracked down on quite hard by the regulator. We do have the benefit of buy now, pay later in the old-fashioned lay-by. I'm old enough to remember those sort of things. There is a benefit to this. And there's a lot of people who don't have access to normal credit or don't necessarily want it. Like generationally, there are people who just are happy to do this. I can see the market that buy now, pay later is serving. And it is serving it quite well, but it's like everything. If you eat too much ice cream, it'll be a problem, but ice cream is not a bad thing by itself. So I think the criticisms of buy now, pay later, when you strip back the posturing, often tends to be that people are using it too much without a thought to the impact in their future credit history and those sort of things. Whether that justifies bringing it into the credit regime, though, is another thing entirely. And I have a suspicion that despite submissions by certain parties, I'm not sure it will be, especially because when you look at the consumer data right regime that's been rolled out to the banks, they're not doing that much different to what some of the more obvious buy now, pay later companies are doing. Essentially, my view is that the real angle for people like Afterpay and everything is not necessarily that someone's paying 4 lots of $25 every 2 weeks or something. It's the access to data, because data is the new gold for everything, the new oil, really. I think everything turns around access to data and accumulation of it because of the value that is inherent in the networks of data. So it's a bit hard for the banks on one side to press for regulation, where on the other side, they're being forced to do exactly what Afterpay would do in the end. Afterpay could easily become one of those entities that requests on your dashboard, and I give my bank data over on the consumer data right dashboard. So there's about 4 or 5 different forces moving around here, all with their own interests, obviously, and hidden agendas and open agendas. So that's a long answer to a short question. In that I'm unsure that there's much regulatory appetite at this stage to take on another large piece of work like that would cause some indigestion, I think, because there's an awful lot of people who do find the buy now, pay later structure useful. It serves a need. It wouldn't be, maybe some people think the need is crass consumerism. That's one criticism, but it does serve a need. It serves a need that I think the days of the 21% credit card from the bank, if you didn't pay within 55 days, is necessary. That didn't necessarily meet that need, and it ended up with a lot of people being caught. When you saw over about 5 years ago the reforms that the bank has to state on the bottom, or the credit provider has to state on the bottom, how long the minimum repayments will take to pay off the debt and all of those sort of things. So I can see a real benefit to it for pure consumer transactions. I do understand the point that it's very easy when it's broken up into bite-sized pieces that eventually you order the whole smorgasbord without realizing that you've actually got to digest it later on. And so it's very easy. Oh, this is only $12. This is only $25. And eventually people end up having with large fortnightly payments. But then again, there's built-in mechanisms in a lot of the buy now, pay later apps and all that tend to move against that, because if there are defaults, there are big problems for the app provider itself. So I don't know the answer, and I think even if you were in government, you wouldn't know the answer, because they are just running around at the moment trying to work out what they use the limited bandwidth they have to do. And at the moment, everybody's borrowing money everywhere, including the state of Australia, and all the states themselves want to as well. So once again, I think what it is my theory is we're in a tunnel at the moment where the old post-war consensus is broken. We no longer have 5 employees to pay for 2 retirees with pensions and things like that. There's a whole new world developing that we're beginning to see the glimpses of now. Disintermediated finance, disintermediated everything. People living at home and not coming into work as much. People living in a matrix, in a sense, where they spend much of their time at home and consume things virtually. This isn't necessarily a bad tool or a good tool. It is a tool, and it can be used in different ways. So I don't think the government or any regulator wants to squelch it completely. And there might be a risk, if you roll it into the general regime, that the whole thing gets extinguished and someone else does it anyway overseas.
Sure. And one of the examples I've seen recently of the traditional big banks sort of scrambling to keep up with the innovation and competition is they've introduced no interest credit cards that have a monthly fee. Is that something you see developing further in future? And not really too sure about where this is heading, but is that an example of the big banks panicking?
Or I can see it developing further. It might be an example of the opposite in a sense, because of course the banks then have the ability to them, they could swallow up maybe not an Afterpay anymore, but that's the risk for Afterpay, that people like Afterpay have a first mover advantage, but not much of one. So it's very easy for someone else like a bank to replicate their model with their bank's access to finance in a way that would just dwarf Afterpay's access to finance and cash flow. So that's a risk for someone like, and I'm not a stock market analyst or anything like that, but it's quite easy for a bank to, they are in effect replicating the model, because you still pay the amount of money, however the pie is broken up. The consumer pays the money, and it just bits of money go to the merchant and bits of money go to the funder, and those are things in both models. But the banks have obviously a larger network. They also have access to the traditional credit card badges as well, with behind the scenes payment obligations and those sort of things, and service and access fees. They had the ATM network, which seems to have fallen into disuse very interestingly this year, and I'm not sure it'll come back. But they do have they may not have the first mover advantage, but they have the size advantage. So I think the market will, in a sense, I don't think they're panicking. I think in a way it's the opposite. They're going, this is a good thing and we can do this quite easily. Where Afterpay has an advantage is in the data. Everybody leaves the data exhaust, and Afterpay has got that access to what people look at as a choice demographic. I understand, like 20 to 30 year olds or young. That's traditionally looked on as one of the holy grails for marketers. If you have Afterpay's level of data on the habits of those people, I think last year when I was doing a lot of privacy work before this year, I would say to people, would you prefer to have what your comments on social media or your banking details leaked online? I don't mean for stealing, but one of them tells much more about you than the other. And it's your banking details, what you pay. It tells people where you are and what you buy, and that sort of stuff. So the banks have a great advantage over other people, and they have a vast trove of data. It means that they can do the same sort of structures that Afterpay and those sort of people do with cookies, just having advertisements pop up or special deals pop up. So maybe they think they're late to the party, but I'm not sure they're panicking. I think they've got some pretty wise marketing people saying, we can do this. Why didn't we think of it? Let's do it now. So it's a different take, I think, on the same conduct.
One argument we often see around buy now, pay later is how it could potentially hurt consumers. Now, if they pay all their little chunks on time, there's virtually no penalty. However, any sort of regulation, especially ones that are rushed through, often have a sort of unintended consequence. And I'm sort of thinking about the other side of the buy now, pay later scheme, which is merchants. Now, Afterpay charges 3 to 7%, depending on the value of the sale. Now, if they were credit regulated, could you see merchant fees going up, or merchants paying in some other way because it's harder to get consumers onto the platform?
It's hard to say on that, I think, because there were 2 points in that, I think. If you do pay up everything on time, I think the only risk is what's called in Australia now the Wagyu and Shiraz point. If the bank looks and sees that you have, when you want to go for a mortgage on a property, when you finally grow up and stop wasting money on buying clothes or whatever, which I still aim to get to one day, then if there's a massive history of you buying lots and lots of stuff online, maybe the bank might, I think the theory is, or the fear is, that the bank might not lend you money because they think you're a wastrel or couldn't make the payment. That's been blown out of the water a bit by the federal court, saying, well, of course you might live in a very fancy way, but it's not a bad thing. You can stop living like that if you have a mortgage to pay. And I think the evidence is everybody pays their mortgage first in Australia, because we have recourse loans where the bank can bankrupt you if you don't pay your mortgage. So people suddenly learn that they don't need all those fancy things that they did when they were younger, when they've got a mortgage. The other thing, that's a more interesting point, what the merchant fees are. I don't see it too much affecting access, because merchants are hungry for anything at the moment. And I think as we see smaller businesses fall away with the current government regulations, you will get a smaller pool of much larger retailers, even if they have different badges to the public. I think you'll find already, for example, that most Australian fashion labels are owned by basically two Melbourne and one Sydney family companies. And I think what you'll find is probably more innovation in terms of marketing and advertising and deals done in the interim, because a lot of these big sellers are essentially, a lot of the car manufacturers, essentially banks or finance companies with a manufacturing company attached. They lend people via Audi Finance the money to buy their products. I've never really understood that, because if the local corner shop did that, I've never really, it would go bust pretty fast. But these things are so big that they have an interest in selling more and more stuff just to keep their finance companies going. So I can see them getting to the size where they say to the banks, no, it's going to be 2%. Not the banks saying it'll be more. So in a way, that could, in a sense, be a correction mechanism to the market itself. It does leave us at the mercy of very, very large conglomerated sellers and banks, but we're going there anyway. I don't think we may as well try and get some benefit out of that. So it may not be a bad thing.
I was speaking to the CEO of OpenPay, and he said that if these regulations were to pass through, that there'd be a concentration of buy now, pay later platforms, rather than there seems to be one new one every week at this stage. Could you see a concentration happening if that were to pass?
Yes, and that is, I think, one of the downsides which will play in the government's mind, because governments are notoriously bad at working out which innovation is a really useful one. Markets tend to be better at it, because lots and lots of people making individual decisions about their own benefit work out which app is better. obviously people make stupid mistakes, but governments tend to make even more stupid mistakes than people generally. So you're right, if it became regulated, then the first movers, Afterpay is a classic example. It could go out tomorrow and get itself a license. You know, it could pay lawyers and consultants $250,000, you know, on today's stock price change. You know, it's not even, it's worth so much money in terms of market cap and those sort of things, and got access to so much money that, so yes, it would, they wouldn't be unhappy with that, I would assume. And also because then they would become like the Baptists and bootleggers. They would then be able to crowd out new people who are nipping at their heels with newer ideas, because they were young people with a great idea once and wanting to come along and innovate. And a lot of big people would have loved to have squelched, or would now in hindsight have squelched them, but they didn't. So the government's very wary of not just this government, but all governments now, because, and the regulators are wary as well of just extinguishing potential new innovation via regulation. So yes, I could see it happening, but that's why I think it'll be, I'm not sure the government has a huge appetite to do it, but it could be persuaded, I suppose, if there were some really bad examples, which nobody has seen yet because everybody's in a bit of stasis. So everybody's shopping away, but nobody really has seen people bankrupted by the use of Afterpay, for example. Terrible sob stories yet, and probably because it's almost impossible. I think Afterpay has a self-correcting mechanism and stops you buying any more if you start to default. But I think in next year, when the dust starts to settle on this year, things might get back into action again. You'll get the same, all the different forces sitting there and clashing as to what they want with their ulterior and open motives.
And I'm not sure if you can talk much about the Afterpay share price. You know, it seems to be accelerating quite rapidly. Is that something credit regulation could hamper? Because a lot of the price seems to be based on hype. And could that kill the hype?
Look, I don't know. My suspicion is no, because it said it could get a credit license tomorrow. It would easily kill a hype of smaller new ones, because all of these things people are essentially buying on the US model. They're not buying for dividends anyway. They're buying for appreciation of the share price. So that they're hoping that someone will come in 2 months' time and offer them more. Having said that, of course, because in the end, you're still all just bidding to have a key to get into a room with a certain amount of gold, which are the dividends. And it's a question of how much money are you prepared for that to pay for that key. But that's the US approach to stock market, whereas the older approach, the Anglo-Saxon and English and Australian idea, was you buy stocks for dividends. That does seem to be falling away at the moment. So I couldn't see it really affecting Afterpay's share price. It might even go up if people realize, institutional investors realize, well, these people are ready to get a license and extinguish all opposition. You know, they could do it in a week, provided the regulator has the time and all that. But but it would be an issue for some of the smaller ones who are trying to look for funding and those sort of things, who aren't necessarily on the stock market yet, but are smaller new competitors and innovators and that sort of thing. And as I said, the people that Afterpay were once when they started, 2 kids with a great idea, you know, and they might get squelched now by that. So that is the problem the government has to juggle with.
And final question from me: have you personally used buy now, pay later?
Not in that. When I was young, because I'm so old, I did use lay-by, but you didn't get the goods.
Yeah, that's right.
Now that was a world when delayed gratification was sort of normal. Now we live in a world of instant gratification, so I don't think anybody uses lay-by. So I have not used it because I'm at a certain age where I have a debit card only, because I don't even have a credit card. But I'm in a slightly odd part of the world where I think...
Toby, God.
No, I think it's because I just straddle that era of, I remember an age before 2007, before smartphones. And I think that's a big cleavage in the way the world worked. It was before smartphones and after smartphones. And I'm a straddler in that sense, and I keep up, but I'm not one of those people who've never been alive without consumer internet, things like that, you know. So I haven't, but I don't really need to, I suppose, because I have too much stuff already. And any way I can stop acquiring more, the better.